Federal Reserve meeting over the next 2 days on interest rate policy. I'm joined now by Kohli. He's an interest rate strategist at BMO Capital Markets. Nice to see you here.
Nice to see you too.
So it's widely expected the Fed will not make any sort of move this meeting, but what are you looking for in getting a better understanding of the way the Fed is thinking about future meetings?
Absolutely. I think the Fed has a very difficult tightrope to walk. We've seen a lot of strength in data. We've seen the data that they have said would be strong enough for them to hike, yet some of the more recent impulses have been very negative. The dollar strengthening, some of the employment data even from last time wasn't as strong as the Fed would have liked. So they have to balance a hawkish assessment of the economy and keep the door open for a December hike, while at the same time making sure that they acknowledge the strengths that the economy has shown and some of the potential risks as well.
Are some of those potential risks weakness overseas? And certainly we saw the ECB make some noise about future QE. China, we know, has got its issues too. So is that going to be part of the balance?
Absolutely. I think those are some of the key risks that the Fed faces, and a lot of that will manifest through a much stronger dollar. And so one of the things that the Fed has to keep in mind is how much of that dollar strength to take into account, because a lot of that will show up with variable lags over many, many months. And so it's difficult for them to assess exactly how strong the economy will be in 6 months or in 3 months when they're actually ready to go.
Aren't we, though, cyclically pretty well into an economic recovery? I know it's been anemic and it hasn't felt like it, but just historically, the economy's been growing now for years. So aren't we overdue, actually, for the economy to slow down?
Yeah, absolutely, and I think that's one of the other risks. It's one of the reasons that the Fed wants to hike, and I know it sounds a little counterintuitive, but it's the one method that gives them the most ammunition to cut again if they need to in 18 months.
So you are expecting December?
We are expecting December right now.
Some market participants think March.
Some market participants think March. In fact, that's where most of the market is pricing right now.
Yeah.
And the reason we think December is partly because the overall data has improved enough and it's met the threshold that the Fed has told us. I think the big risk for them is how much of the dollar weakness from emerging markets and those other components is really going to bleed back into U.S. data.
So elsewhere in Washington, there's actually an agreement on a budget, which I think is surprising to a lot of people in terms of the political wrangling. How does that factor into what's happening with the economy and what the Fed has to take into account?
I think there are several things that it could have done to keep the Fed on hold in December, and I think a lot of that has now been removed. And I think it's important to remember that not having a budget in place would have actually shut down a lot of the agencies that collect the data that the Fed needs. So it may have postponed the Fed for much longer than even December. And so removing that barrier, I think, makes it much more likely that you'll see a hike by year end.
That's a great point, actually. All right, for a bond investor, somebody who wants to be conservative, somebody who's maybe a little nervous about the stock market, if the Fed is raising in December and you want to be in government debt, where on the yield curve should you be positioned right now?
I think on the yield curve, you should be as far out as you possibly can.
30?
The 30-year, exactly. I think the 30-year would be a great spot to be, and I think it'll benefit immensely if the Fed does raise, and if they make a policy error, you'll benefit even more.
And how about outside of government debt? What do you like right now in the bond market?
I think outside of government debt, we're a fan of mortgages. We like owning those as well, and I think right now equities are probably entering a bit of a turbulent period, partly because of the dollar's strength and partly because of the Fed's hawkishness.
What does that mean for corporate debt, if anything at all?
I think corporate debt will continue to face a little bit of stress. There's a rush to issue before the ship sails, so to speak, and before the Fed really starts to hike rates, and I think that could put more pressure on corporate spreads, as it does on equities.
Kohli, it's great chatting with you. Thank you so much. I'm Rhonda Schaffler for The Street.